Well, welcome to this online course on risk management in Islamic banking and to the first module, which is an introduction. In our first slide, I want to discuss the learning outcomes. The learning outcomes will be the market for Islamic banking, which we'll discuss in some detail. We'll then move on to discuss the objectives of risk management in Islamic banks. And lastly, we'll look to demystify some of the risks in Islamic banks, notably dispelling some myths, as well as emphasizing some of the realities. We now discuss the market for Islamic banks. The first modern commercial Islamic bank was established in 1979, and since then there are now no fewer than 105 countries in which Islamic banks are operating. Geographically, these are concentrated in the GCC and in Malaysia, but significantly, these countries also include Turkey and Iran. Islamic banks can be one of two types, just like conventional banks. They can be either investment banks or they can be commercial banks. Principally, the main difference between these two types of banks is whether or not they take retail deposits. In addition to that, investment banks have investment banking assets and commercial banks don't. However, particularly in the GCC for Islamic banks, some commercial banks are much more like investment banks than you would otherwise think, holding investment assets such as real estate, for example. Islamic institutions compete alongside conventional institutions in their home countries, almost always. This has come to be known as a dual banking system, and today there are only a handful of countries which operate only a purely Islamic banking system. Lastly, Islamic banks are regulated, and they are regulated by the regulatory supervisory authorities in their jurisdictions. A very important risk management standard setting body called the Islamic Financial Services Board has now become established to write risk management practice standards for Islamic banks and their regulators. We now move on to discuss what risk management is. The objective of risk management is the same for Islamic banks as it is for conventional banks. In summary, the objective is simply to prevent unwanted changes. Now, risk management is something we do in our everyday lives without even thinking about it. For example, if I cross the road, I have to understand that there is a risk to my safety, and that risk is posed by cars. I might measure that risk by understanding the speed of approach of those cars, and then I might wish to control that risk by deciding when and how fast to cross the road. Now, it's a simple example, but risk management in finance is really no different to that principle. Modern financial risk management is very similar, as I say, to risk we encounter in everyday life. However, because financial systems and banks are often very complex, and some of the risks that they run are both complex and interrelated, Islamic banks need a formalized risk management framework in order to identify and measure and also control risks to which they are exposed. We now move to the next slide, in which we discuss some of the myths around Islamic banking and seek to dispel some of those myths for you. As we know, Islamic banks do not pay or receive interest. Their income is, however, affected by interest rate movements. This is because of a type of risk called benchmark risk, in which Islamic banks benchmark the price of their assets and liabilities to conventional interest rate benchmarks. We also know that Islamic banks can use financial instruments to transfer away some types of risk. However, conventional derivatives are not allowed for this purpose. Nevertheless, a limited number of Sharia-compliant financial instruments are available to transfer away risk. Importantly, risk sharing does not mean risk seeking. As we know correctly, Islamic banks operate to seek a profit, but they do not necessarily seek risk. They in fact prefer to avoid risk, which is avoidable and not necessary for them to incur. Lastly, Islamic banks are indeed affected by turmoil in conventional markets. We saw this with the global financial crisis of 2008. As we know, Islamic banks did not hold toxic assets, but due to the interconnectedness of financial markets and the uncertainties around what would happen as that crisis unfolded, confidence in the market evaporated, and with it, Islamic banks did suffer quite considerable liquidity stress. Well, now that we've dispelled some of the myths, it's now also important to emphasize some of the realities around risk management in Islamic banking. Now, this is an important slide concerning how some aspects of what Islamic banks do and how they work does affect risk. Firstly, Islamic banks do not speculate, and this means that they avoid holding investments for speculative purposes. Islamic banks also have a limited opportunity to transfer risks. In conventional banking markets, conventional banks can use derivatives, and as we said before, Islamic banks have access to a limited number of financial instruments to use for those purposes. For Islamic banks, financing is also asset-based, and this means that we have identifiable assets which underpin each of the financing transactions. The consequence of that is that there are identifiable assets which can be used as collateral against those receivables. Now, Islamic banks do face higher funding risk. The funding risk relates to being able to finance their operations and to fund their assets from money provided by people other than the bank owners themselves. The issue around this is that that money may be fairly short-dated with fairly short maturities, and the threat or the risk to the banks is that they would not be able to renew that funding source once its maturity date is reached. Lastly, points 5 and 6 say similar things, that Islamic banks are less leveraged than conventional banks. So this also means that they are better capitalized and therefore better able to absorb risk and absorb losses if they occur. In essence, the owners have a much larger stake in Islamic banks than they do in conventional banks. We now reach the concluding slide to this module. To recap on some of the things that we discussed, we have explained the market for Islamic banks, and importantly, that Islamic banking is concentrated in the GCC and in Malaysia. We've also clarified the objective of risk management and understood that the objective for risk management in Islamic banks is really no different than it is in conventional banks. And lastly, we've dispelled some of the myths and emphasized some of the realities which have a bearing on risk management in Islamic banks.